Hi everyone, you're listening to the PE Pulse miniseries on EY's Nextwave Private Equity podcast. My name is Pete Whitty. I'm the lead analyst for Global PE here at EY, and a big part of my job is to help people understand some of the key trends and themes that are happening in the market and to help folks make good decisions based on a better understanding of some of those dynamics. Now, the PE Pulse is a report that we've published for almost 10 years now at EY, and now, for the first time, we're taking it into a podcast format. So, over the next 10 minutes or so, we'll try to give you a good sense of what we're seeing in the market right now and what the outlook is for the next few months. To read the quarterly report and to download an infographic, visit ey.com/PE Pulse. And so let's start with deals. And I'll say this, things naturally kind of slowed down around the holidays, as they always do. But when people came back, January 4th, 9 a.m., our phones were ringing off the hook with private equity firms looking to do deals. And you can see that reflected in the numbers. It was an absolute monster of a quarter for PE deals. We ended up with somewhere around $260 billion in deal value in the first quarter. You compare that with the first quarter of last year, which was around $130 billion or so. It's essentially double that. And remember, COVID wasn't even really on the radar for most folks in the US and Europe until mid-February or so. And it didn't really start impacting the deal market until March. So the year-over-year comps aren't as depressed as they will be when we look at Q2 next quarter. So it's interesting, right? And it's sort of this combination of a pandemic bounce and some strong secular tailwinds. Now, we saw rises across all regions. The U.S. and the Americas were up about 140% by value. Asia Pac was up about 170%. Europe up about 60% and change. So it's not like one region was doing all of the heavy lifting. From a sector perspective, I think one of the things that's been interesting about the recovery here is the degree to which it's being led by investments in the tech space. Now, we all know investment in tech's been a pretty powerful theme for, call it the last 5 years or so. And when we talk about tech, we're really talking about tech investments all over the spectrum. You see PE firms that are doing buyouts or sometimes doing take privates of these large legacy SaaS firms. They've got strong recurring revenues, but maybe they're not fully prepared for today's competitive landscape. And so private equity firms are able to take these companies and transform them away from the view of the public markets. And at the same time, you also have firms that are moving down market into the growth capital space, making the types of investments that they probably wouldn't have done a decade ago. And the pandemic sort of threw gasoline on some of those trends. In the first quarter, tech deals made up about a quarter of private equity investments globally, and in the U.S., it was more than a third. And that's where private equity has been looking into the landscape. They're trying to figure out who the winners are going to be for this post-COVID world that we're all entering, and they're trying to place some bets accordingly. But overall, Q1 was the single biggest quarter for private equity, going all the way back to 2007. And so the takeaway, I think, is that we're clearly moving into this risk-on phase of the market again. With the pandemic winding down, all of those companies where people had a hard time arriving at valuations because you just didn't know what the outlook was going to be, well, they all have a lot more certainty now than they had 6 months ago. And so some of the deals that were put off at this time last year, we've started to see, work their way into the pipeline over these last few months. And then moreover, we're seeing private equity firms that are looking to deploy some of that dry powder that they have and get positioned for, what most folks expect will be a major upturn in spending as people emerge from their homes and get more active again for the first time in a long time. And so that's a theme that I think we see play out over the balance of the year. The challenge, of course, is no different than what it's been for the last several years. It's just exacerbated, and that's valuations. I think what's interesting about the pandemic period is that while some firms made great investments last April, May, June, in the credit space, pipe space, that sort of a thing, and they did so at really compelling prices, for the most part, traditional LBO valuations, they didn't really move that much. Average LBO was done at a purchase multiple of about 11.5 times EBITDA last year. You compare that with 2007 when it was about 9.5 times EBITDA. So, 2 full turns. And so firms today, I think when they buy these companies, they have to know that they're the right owner for the business. And they have to have a rock solid value creation plan that's really rooted in their unique capabilities. Otherwise, I just don't see how it works. So let's move on to fundraising. While deals were way up, fundraising is really an area that's probably been impacted the most by COVID. This is an area where we've seen a slowdown, and I think that's for a couple of reasons. One, obviously, firms couldn't go around and do roadshows like they have in the past. And a lot of PE funds have switched to virtual fundraising, which is a trend that we think will persist, at least to some degree, post-COVID. And the other is just a shift in focus, I think. Firms have, tons of dry powder available right now. They spent most of last year either scrambling to save their portfolio companies or looking at new opportunities. And so fundraising is just kind of taking a little bit of a back seat. And so the net effect of that is that we've seen a decline of about 14% over the last 12 months or so versus the prior 12 months. Now, I don't think this is a secular trend. Instead, I expect it's pretty strong this year as people start to focus on it again, and we see some of this pent-up activity come into the market. So now let's talk about SPACs. SPACs, probably along with crypto, have of course been one of the key storylines in the capital markets over the last year or so. So far this year, there have been about 300 SPACs raised, and that's just in the first 3 months of the year. They've raised more than $90 billion in the first quarter, and that's more than they raised in all of last year, and it's about 10 times what they raised in 2018. And I think that there's a few ways that this really intersects with the private equity market. The first is that a significant minority of SPACs are backed by private equity firms. Some have been involved for a handful of years, while we see a lot more firms that are raising vehicles for the first time. Overall, SPACs backed by private equity firms have raised about $25 billion over the last 12 months. So they make up, call it 10 to 15% of the overall SPAC market. But I think the more significant implications are really around what it means in terms of competition for the deals and from an exit perspective. On the sell side, for example, we're hearing from GPs that they're getting inbound calls from SPACs, 2, 3, 4 times a week that are interested in buying their portfolio companies. And indeed, what we've seen is that about 1/3 of the companies that SPACs have merged with since the boom started have been owned by private equity firms. And this is something that's going to continue. Right now there are about, give or take 2,500 to 3,000 companies that are owned by private equity firms that are in that prime selling window. And so that represents a real opportunity for private equity firms to get liquidity on some of those companies. The other dynamic with respect to SPACs is the competition that they're going to be for private equity firms that are out there looking for deals. We talked about the valuation issues. A typical year for private equity deals is somewhere in the $500 billion range. Right now, SPACs have about $170 billion in trust, and that equates to deals when you add in the debt and pipe investors and so on, deals valued at somewhere between $700-800 billion. And all of that has to be spent within the next couple of years. So it's a tremendous amount of capital for the private markets to digest. And so it's one of the reasons when people say, okay, maybe the SPAC boom is winding down a little bit, but frankly, it almost doesn't matter if the issuance stops or slows down. They've already raised so much money that they're going to have a huge impact on the private markets for the foreseeable future. So that's sort of the market in a nutshell. Fundraising's been lower, but we expect that pace to pick back up. Deal activity is higher than we've seen in more than a decade. And SPACs are sort of this wild card. It's going to make life either a little easier or a little harder for private equity folks, depending on whether you're looking to sell a portco or acquire a new one. Thanks for joining today's podcast. We'll be back next quarter with another update.